Okay, sir, recording started.
Hello, everyone. Thanks for joining in today. I think today is the second session of this certificate course on income tax, wherein we are dealing with various heads of income under the Income Tax Act. And today we will be dealing with the profits and gains of business or profession. So let me just share my presentation with you all. Is my screen visible now?
Yes, sir, it is visible.
Great. So today we will be dealing with the chapter of profits and gains from business or profession. As we all know that this is a very huge chapter, and we'll try to cover substantial part of it, which are most important and which we deal in day out. So PGBP's chapter can be divided into various broad classifications, which are basically the charging sections, section 28, 29, income, which is 41, which is the write back of income of expenses. Then various deductions, which are claimed from the income, like 30 to 36, then 37, 43B, 44A, special provisions. Then we will talk about certain disallowances, wherein the expenses are not allowed, and under what circumstances and under what conditions these expenses are not allowed. We'll discuss with that also. Then we'll also discuss some sections related to the presumptive taxation, and also intermittently we'll discuss the provisions of income ICDS, basically income competition and disclosure standards, wherever they are applicable, right? So first of all, the chapter starts from section 28, which is predominantly the charging section of PGBP section, PGBP chapter. The income which is to be taxed under the head profits and gains from business or profession is mentioned in section 28. Whatever and all kinds of income, whatever has to be taxed, are all mentioned in section 28, first section of this chapter. So what does section 28 clause 1 say? It says that profits earned from carrying on business or profession at any time during the previous year. So this is the umbrella provision. Whatever earnings you are making from carrying on of a business or a profession, all those income have to be taxed under the head income from PGBP, right? So this is the umbrella generic provision which tries to cover all income within itself, but then there were loopholes, there were litigation, and therefore government kept on amending the section as and when the need arose, and kept on adding a few clauses to it. So the second clause says any compensation or other payment due to or received by any person managing the whole or substantial affairs of an Indian company. So basically, if you are managing these substantial affairs of an Indian company, these kind of income can also be taxed as PGBP. But generally what we see that a person who is appointed as a director generally earns a salary income. So if there is an employer-employee relationship, then the income will get taxed under the employment head, salaries. Otherwise, it can also be taxed in if there is no employer-employee relationship, but the person is under a contractual obligation to manage the affairs of an Indian company, then whatever remuneration the person is deriving from that company is liable to tax under PGBP. Right? Similarly, B clause, substantial affairs of any other company in India. C is holding any agency in India where consideration is for or in connection with termination or modification of terms of managing directorship or agency. So similarly, if there are any terms, modification of terms, and if there is a compensation payable in that regard, that is also taxable under the PGBP head. Then vesting in government or government controlled corporation, any compensation from that company, that corporation is also liable to tax under the PGBP. Now, E is very important. Earlier, this clause was not there. This was introduced 2 or 3 years back, wherein a lot of litigation was happening that wherever there was a termination of the business contract, and if a compensation was paid, at that point of time, a lot of assessees were claiming that this income is capital in nature and not liable to tax. Therefore, and there were some favorable jurisprudence also in this particular regard. So, for example, in case of Oberoi Hotels, it was mentioned that compensation received for giving up the right to purchase or to operate the property is not for settlement of rights under trading contract, but injury is inflicted on the capital asset of the assessee, which has resulted in the loss of source of income. So when the loss of source of income was held by various courts, they were holding that this is a compensation which is capital in nature and not revenue, and therefore it should not be liable to tax under the head PGBP. In order to avoid all these unfavorable judicial precedents which were hampering or which were inflicting a loss on the revenue of government, they amended the section and brought in clause E to clause 2, wherein it was specifically mentioned that any compensation received for termination or modification of terms and conditions of any contract relating to his business shall be liable to tax under the head PGBP. So therefore, this controversy has now been laid to rest, and any such compensation is chargeable to tax. Then clause 3 says income derived by trade, professional or similar association from specific services performed from it for its members. So we know that there were many trade associations which were claiming themselves to be charitable in nature. So there was a section amendment which was brought in section 2 clause 15, which deals with charitable organization, and there it was mentioned that if any trust or charitable organization is earning any income from business or trade or commerce, then it shall be liable to tax. Such organization will not be considered as charitable organization. So in continuation of that, any kind of professional association or trade association, if it is earning from rendering of services to its members, such income shall also be classified as PGBP income. Then clause A to E are various, 3A to 3A are various clauses wherein different kind of subsidies, duty drawbacks, duty entitlements, those are all listed, and whatever amount is received or any kind of scrip is received from the government, those are also to be considered as income chargeable under the head PGBP. Then under clause 28.4, it says any benefit or perquisite, whether convertible into money or not, arising from business or profession, this shall also be liable to tax. One may not say that the consideration or the compensation has to be received in money only. Many times what happens is that we have rendered services to someone, they say that we don't have money to pay, you can have my product. Say for example, if they are dealing in some laptops or computers, they can hand me over 2 laptops. Then whatever is the value of those laptops will be my income. Similarly, if I am rendering services to a hospitality company, they are operating guest houses or hotels, and if in lieu of my services, they say that we give you a 2-day, 3-night stay, in that case also, whatever is the value of that package, that will be considered as my PGBP income. So it is not necessary that compensation has to be received in money terms only. Even if it is received in some kind of a benefit or a perquisite, similar to a salary section, wherever the value is considered as perquisite and chargeable to tax as salary. Similarly, in PGBP also, there is a provision that even if you are receiving certain other benefits from the client, even then that value of that benefit will be chargeable to tax. Then the other provisions of section 28 says that in interest, salary, bonus, commission received by a partner. So whenever a partner is earning certain remuneration from a partnership firm, so even if it is denominated as salary, it is not chargeable under the head salaries, it is chargeable under the head PGBP. Many times we have seen that the firms or the accountants of those firms deduct TDS on partner's salary, which is not liable to be deducted under section 192. We have seen that this is a general mistake which happens because the salary which is earned by a partner from a partnership firm is chargeable to tax as business profits, business income. And obviously that amount is chargeable only to the extent the amount is claimed as deduction by the partnership firm. So we'll discuss the limits of partner's salary which can be paid to each partner. And only to that extent the amount is liable to tax in the hands of partner. If the payment of, say for example, your salary income or interest on capital which is invested in the partnership firm, that is also chargeable to tax as PGBP income profits. If those amounts are paid in excess of the limits which are prescribed under the Income Tax Act, then such excess is not deductible in the hands of partnership firm as a deductible expense. And to that expense, once it has not been claimed as deduction, the same will not get taxed in the hands of the partners. So that is something which we need to understand and which we need to keep in mind while dealing with the taxation of partnership firms. Then moving on to the next clause, it says any sum received under an agreement for not carrying out any activity in relation to business and not sharing any business or commercial rights which are likely to assist in business. Basically, this is non-compete fees. If I was a partner of a particular firm and then I move out and I exit, and then a non-compete agreement is signed wherein I am not supposed to compete in the same business for next 5 years and a particular compensation is paid to me. That compensation was earlier claimed as capital receipt. Again, that was treated generally claimed as a capital receipt, and it was argued that this is something which is not in revenue in nature, and this is something also a loss of revenue generation source, and therefore it should not be chargeable to tax. To overcome all those arguments, non-compete fees has now been chargeable to tax under your PGBP income. Similarly, if a company has taken a key man insurance policy in relation to a key personnel and on unfortunate incident, the key man insurance policy amount is sum assured is received by the company. In that case, the company shall be liable to pay tax as PGBP income. Then the next clause says FMV of inventory as on date on which it is converted into or treated as capital asset determined in prescribed manner. So what used to happen, if you would see section 45, there is a provision that if stock in trade is converted into capital asset, then there are provision in relation to what will be the capital gain. So that's the other way around. So if a capital asset is converted into stock in trade, in section 45, it says that it will be treated as capital gain transaction because now capital asset has extinguished and stock in trade has come into picture. So similarly, there were reverse case scenario also, and there was no provision in the Income Tax Act to tackle a conversion of stock in trade into capital asset. Now what happens is stock in trade is an inventory, which is a purchased item for which you have already claimed an expense in the P&L or debited something. But when it is converted to capital asset, the amount could have been claimed as expense, but there was no provision of charging the income. So now they say that once you convert a stock and trade into capital asset, there shall be some income which will be computed, the FMV will be computed, and that will be brought to tax as PGBP. Then amount received in respect of capital asset for which deduction has been claimed under section 35 AD. Say 35 AD is a specified business section where you get deduction of entire capital expenditure in the year of expense itself. Specified businesses are, say for example, fertilizer business, your hospitality business. There are many other business. We'll talk about it in detail in later slides. But when you have claimed the entire capital expense in the year of expense itself, and later on if you sell that asset, then whatever are the sale proceed, that has to be now taxed as PGBP income, right? So that will not go to capital gain section. It will be chargeable to tax under section 28. Then some provisions are there in ICDS 4 about revenue recognition. ICDS is income computation and disclosure standards. It talks about all the provision. Basically, income computation and disclosure standards are applicable to all those assessees who are maintaining books of accounts on accrual basis, and their income is chargeable to tax under the PGBP head and other sources. So first concept is accrual basis. So if you are a, say for example, CA firm maintaining books of accounts on cash basis, ICDS is not applicable and accrual system is not applicable because. So therefore, first and foremost condition is books of accounts and computation of income has to be done on accrual basis. So in terms of revenue recognition, what it says is that sale of goods shall be recognized when all significant risks and rewards of ownership are transferred. This general condition, which is also there generally in the accounting standards. And then it says claim of escalation of price or export incentives can be postponed to the extent of uncertainty involved. So if there is any export incentive which is available on export of goods or services, but there are certain conditions prescribed to it and you have not yet fulfilled all those conditions, and if there is certain uncertainty about receiving those incentives, till that time probably you can defer it, but once there are all the conditions have been met, you have to recognize your revenue in terms of export incentives, any kind of government grants also. Then in terms of revenue from service transaction, it has to be recognized on percentage of completion method. Please mind it that as per ICDS now, full completion method is not a method which is prescribed. Even if you are recognizing in your books of accounts revenue on the basis of full completion method, but ICDS says that if there are certain expenses which you have incurred in terms of a contract, then you have to recognize proportionate revenue also in terms of that particular project. And there are certain limits which have been prescribed. They say, for example, if there is a budgeted cost of 100 rupees and you have incurred only 20 rupees of budgeted cost till 31st of March, then you have to recognize the revenue only to the extent of cost, right? Say, for example, 20 is the cost, then you have booked 20 as expense, and you have to also recognize 20 as your revenue. So net your income is zero, but their expense claim which could have been higher is now limited. However, if you have incurred more than 25% of your budgeted cost, then the provision says that if your projected revenue from this particular contract is 200, say for example, then you have to recognize the proportionate revenue also. Say for example, if you have incurred 40% of the expense, means 100 rupees of expense, then 40% of 200, which was the revenue of the project, 80 rupees. 80 rupees is also to be recognized as revenue of the project. So net you have to recognize 40 rupees of profit. So this is how percentage completion of method works as per ICDS. This is absolutely the mechanism which has been written in the ICDS provision, right? Then further it says that dividend has to be recognized under as per the provisions of the Act. Although dividend is not chargeable to tax under the PGBP head, but when we are discussing revenue recognition, we are just discussing it. And royalty as per the terms of royalty agreement. So if the royalty agreement says that it has to be in percentage of certain revenue earned, then whatever is the revenue earned, the percentage of royalty has to be recognized. Even though I have not received it, even though I have not raised a bill, on the proportionate basis, on the basis of the terms of the contract, royalty income has to be recognized. Similarly, interest will be recognized on time basis. Many times interest income can be chargeable to tax under the PGBP head also. So wherever interest income is chargeable to tax, either under PGBP or under other sources, it has to be recognized on time basis. So wherever, however, if interest refund is due, interest on refund is due on certain government refunds, then it can be postponed to the extent when it is received. So say for example, if the interest has been determined in assessment order, but that interest has not yet been paid by 31st of March, then you can claim a position that we are not going to offer it to tax because it is a government refund, and government refund has been specifically carved out, and it has been mentioned and it has been provided that you can recognize it on receipt basis. Similarly, if there is a discount on premium or on debt securities, that can be accrued over a period of maturity. Then income chargeable under the head 28, which is related to subsidy, grant or incentive. As we just discussed, any grant, subsidy or incentive which is received from government is now chargeable to tax under the head PGBP. Clause 18 to section 224, which defines income. has been specifically inserted by Finance Act 2015, and it specifically mentions that assistance in form of a grant, subsidy, or cash incentive, or duty drawback, or waiver, or concession, or reimbursement by the central government or state government or any authority or agency in cash or in kind to the assessee shall be regarded as income and income under the head PGBP. Earlier, there was used to be a lot of controversy in terms of such kind of benefits made available, because assessees used to argue that this is something in the nature of capital receipt, not chargeable to tax. They used to say that a grant or a subsidy, whichever has been given by the state government, it is to boost infrastructure development, to boost capital investment in that particular state or that particular region. It has nothing to do with their business. So they have just made investments, and because of the investments, there has been a subsidy which has been given. So therefore, there used to be a claim that such kind of subsidy and grant are capital in nature and so therefore not chargeable to tax. And there were rulings from Supreme Court also in Pony Sugars, where such scheme in question was linked directly to setting up of a new unit or expansion of an existing unit. Subsidy received is not in course of trade, but is of capital in nature. Similarly, Balaji Alloys, it said excise refund or interest subsidy received in pursuance to incentives announced and sanctioned pertaining to industrial policy introduced in the state is a capital receipt and not chargeable to. So all these favorable judicial precedences were now contravened by this particular amendment, and now any kind of subsidy, if it is received, it has to be chargeable to tax as PGBP, provided that there are two exceptions. One is that this subsidy is actually in relation to investment of a capital asset. As you would see that in section 43, there is mentioned that if in respect of any capital asset we receive any subsidy, that amount has to be reduced from the capital cost of the asset, right? So ultimately, either now it will be chargeable to tax under the head PGBP, or it will go on to reduce your cost of capital asset. So ultimately, the depreciation allowance is going to be lower. So it is not a case now that it is going to go unscathed. And it is not going to either be chargeable to tax under the PGBP and it is going to be just said as capital in nature, receipt of capital in nature. That is not going to be the case, right? Or if the subsidy or grant is towards corpus of a trust or an institution. Now someone may ask that trust or corpus or institution is in any case not chargeable to tax under the PGBP head. It may happen so that they are not registered under 12AA. Not all trusts or not all institutions are charitable in nature. So if a trust is running a business and they receive certain corpus amount from government, then such corpus amount shall not be liable to tax as PGBP income. Right? So this is also a brief summary of government grants, which is as per ICDS 7. It talks about, this is also something which is now mentioned in the Act also. So what is it? Basically, subsidies, concessions or reimbursement, waivers, duty drawbacks, cash incentives, by whatever name you call it, any kind of government assistance is now called as government grants, recognized as government grant, and it has to be charged to tax. Now, at what point of time it has to be charged to tax? First, a reasonable assurance about the receipt means you know that you have fulfilled all the conditions which are prescribed under the particular policy of a government, and then you believe that you will be able to receive that particular grant. At that point of time, you have to recognize it. In any case, if you have actually received that grant, you shall not defer it. Means even if the actual receipt is under protest, may say, for example, many times it happens that government gives an injunction and says that government has to pay it. So the court has directed the government to pay it. So once you have received the amount, even though it is litigated by the government, it has to be recognized as income. And then a reasonable assurance on complying the conditions. So that is what the basic concept is. Once all these concepts are met, you have to recognize government grant as income. Now some more concepts which are related to section 28 are basically what has to be taxed is real income. Real profit have to be taxed. What does real profit mean? Real profit is basically what you are actually going to earn. it should not be something notional in nature. Many a times what we have seen, there were some cases, I was dealing with one of the oil majors. What they used to say is that they used to give contracts, subcontracts to certain gas producers in particular regions. Now there was a minimum guarantee which was to be provided, and the subcontractor had to produce certain minimum amount of gases from their oil fields. So in case the minimum guarantee was not produced, there were clauses of penalty, which could contractual penalty, which could be levied by the oil gas company producers to on these subcontractors, right? Now, many times it used to happen that the subcontractors did not produce the minimum guarantee amount, and they used to go into litigation, and there was a long history that the oil companies were not able to generally recover that particular money from the subcontractors because of various reasons. The subcontractors used to argue that there were not particular conditions available, there were other force majeure clauses which were applicable, and therefore they could not produce. So what they used to do, the oil companies, they used to recognize the penalty amount in their books of accounts, right? Because it was a contractual liability which they considered subcontractor were liable to pay, right? But they were actually not able to press it, and they were not able to recover it anytime. So it was just accumulating. So in that particular circumstances, the concept of real income was triggered, and then we provided an opinion to them that this is something which is notional income, and as per the judicial precedent in the commercial cases also, you have never won these cases. You have always suffered a loss, and therefore you should not recognize this income as real income, even though to pursue your claim you have booked it in your books of accounts in P&L account. This is not an income which is real income, because the ultimate possibility of realizing this income is almost negligible. So similarly, there can be other circumstances wherein there are certain claims which have been made, but they may not be real income, right? So real profits are actual profits that are computed on the basis of ordinary principles of commercial trading and commercial accounting. Notional income such as notional interest on interest-free loan cannot be cannot be part of profits. So many times in India's accounting, you would see that notional interest is recognized in your books of accounts, right? Wherever you have given deep discounts in loans, or you have given long-term loans without any interest to your related parties, then India says that no, you have to recognize certain interest portion also on this particular amount on the basis of certain discounts and NAV. So even though you have recognized interest income in the books of accounts as per some accounting standards which are under Ind AS, that may not be resulting in any real income to you as per Income Tax Act. So therefore, all those income and all those notional amounts have to be recognized and identified and removed from your chargeability to tax. Charge of taxes not on gross receipts, but on profits and gains. Absolutely, we all know that PGBP is something which has to be computed on net basis only. My gross receipts are chargeable to tax, but only after claim of eligible tax deductions. So nobody can say that you will not be allowed any deduction. Obviously, I have to be allowed all my eligible claims of expenses. Now, what does business means? Business is also defined. It says business includes any trade, commerce, or manufacture, or any adventure in the nature of trade or commerce or manufacture. So there are a lot of judicial precedences on the business, on the definition of manufacture, wherein even a single trade, even a single adventure in the nature of trade or commerce has been held to be business in nature. So this is something which is fluid in terms of it all depends upon the facts of a particular case and circumstance. However, one may not be able to say that I've just done it once, so it is not my business. That may not be an argument if it was in order to earn profits if it was done with an intention to be in the nature of trade or commerce. So therefore, one has to be very careful while determining whether an income is particularly in the nature of business or not. Many times when we deal in securities, in commodities, in those particular scenarios, probably we try to take a position that it is always capital asset, capital gains. So therefore, in those circumstances, you need to weigh your circumstances and facts and then determine whether this was particularly in the nature of business or it was in the nature of capital gains. Business, it also further says, it connotes some real, substantive and systematic or organized course of activity or conduct with a set purpose, profit motive not being relevant. So one thing is very clear that it is not a determinative factor that you carried on a trade or commerce to earn profits. It may not be so. Even if you are not doing certain activity for earning profits, but it is in the nature of trade or commerce. Say, for example, charitable organizations, many business trade and associations, wherein they are rendering services to their members. So in those particular circumstances, earning profit is not their objective. Their objective is to benefit the members, to render particular updates about the industries to their member, to do lobbying with the government, to do certain research in their own field, right? Or to create a lobby of their members. So all those objectives might not be profit generating, but if they are undertaking certain activities which are in the nature of trade or commerce or business, in that particular scenario also, these organizations will be chargeable to tax under the head PGBP. So profit motive is not a determinative factor. Please keep that in mind. Right? Now, coming on to profession, this is also defined. Profession includes vocation, very generic definition. But in general circumstances, what we understand by profession is, which is generally backed by a certain educational qualification, wherein it is in section 44AA, it's also defined. Certain professions are included in this particular terminology, but it is not definition of profession per se for the head PGBP. So profession generally, when we talk about is doctors, engineers, lawyers, accountants, architects, your information technology, your technical consultants, all these are generally considered as profession because all these are backed by certain educational qualification and it requires specific skill, certain skill set, which is acquired through a lot of learning and going through an educational process. So therefore, profession means, and why it is different, why it has to be considered as different, because there are certain provisions which distinguishes between provisions between income of business or profession. Say, for example, the presumptive taxation, 44 AD versus 44 ADA. So 44 AD, while it talks about business, 44 ADA talks about presumptive taxation on profession, and the profits chargeable to tax are different. So vocation, it says, which has been held as analogous to one's calling, such as preaching of one's religion. It may be vocation. Profession refers to an occupation requiring intellectual skill or manual skill, such as painting, sculpture. Section 44A and Rule 6F, it talks about various professions such as legal, medical, engineering, architectural, accountancy, technical consultancy, interior decoration, authorized representative, film artist, company secretary, information technology. All these are considered as professions as per section 44. Then profession is mutually exclusive from business for the purposes of this act. This would imply that references to business would not automatically apply to profession unless the profession is specifically mentioned. So if you would think about this, there was a section which was on the different slab rates of up to 15 lakh. There were different slab rates which has been prescribed under 115BAC for individuals and HUF. And there earlier the profession term was not mentioned for certain particular purposes or particular provisions of that section, and later on the profession was added to it. So therefore, we have to see that wherever business is mentioned, it does not mean that profession is automatically included in that. So any questions till now? I would be happy to take the questions. There are a few questions. Can you define the definition of gross profit as the CA required to certify in his audit report? So gross profit means generally the direct profits. As such, it is not defined in the act. It is generally to be considered from an accountant, from the general accounting principles which we derive, that whatever are the direct costs of a business, those direct costs generally it is in the trading businesses or in the manufacturing businesses wherein the gross profit is generally computed. In terms of service industries, generally gross profit is not computed, but people do put in various figures. Many times net profit is put in as gross profit, but it is fluid in terms of service industry. So there is no concrete definition. It goes by the professional judgment of the accountant. Then the next question is, as you explained the case of Oberoi, in my opinion, the alleged judicial pronouncement as well as inserted provision is neither a capital income nor revenue income, but same should be deducted from respective capital assets. So in future, the claim of depreciation reduced accordingly and state will get more revenue. Sir, I have already mentioned it. Many times the subsidy is in relation to the capital asset, but sometimes the subsidy is not in relation to capital asset. It just says that you put in, say for example, 10 crores of investment in my state, and we will give you a rebate in the sales tax, or earlier it used to be sales tax. Now it may be either some other kind of duties or whatever the state is levying, or they may give electricity concession. So in those cases where such concessions are being provided, in that particular case, it cannot be related to a particular capital asset. In those circumstances, whatever concession is being received, that will be treated as your PGBP income itself. So you cannot claim, say my electricity bill was, say for example, of 1 lakh rupees, and now it has been reduced, or they have refunded me 30,000 rupees as subsidy. So I cannot claim lakh rupees of expense as electricity and then say that 30,000 is my capital receipt, and nor 30,000 is going to go against any capital asset. So that has to be taxed now as PGBP income only. Earlier, the SSCs were claiming that this is capital in nature because it is related to my capital investment. And because to promote capital investment in the state, this government has come up with this policy. So therefore, this is a capital receipt in nature. So earlier, that was the position which was being taken. Now it has been allayed. It is now gone with the amendment in the act. Right? What is the meaning of fair market value under Income Tax Act? Sir, it depends. There are various rules depending upon situation to situation. There are different rules which have been prescribed for determining the fair market value under different circumstances. In the order of interest is passed before the closing of book, but not received. If the order of interest is passed before the closing of the book but not received, then the interest to be taken. No, sir, I have mentioned that I think that you are talking about, this is some PC. I'm not sure who is asking this. So this is question which I'm assuming that this is an order of interest which is arising from a government order, either from income tax or sales tax or service tax or GST, whatever is the income, and interest is arising from that order. Now ICT has clearly mentioned that if it is an interest which is arising from a government refund order, then it can be recognized in the year of receipt. And it does not matter that the order has been passed before the closing of the books, right? So you can claim it in the year of receipt. If dividend is chargeable to tax in violation of constitutional provision. Sir, I'm not sure what do you want to say here. As double taxation on distributed, dividend is chargeable to tax in violation of constitution provision as double taxation on distributed profits. No, sir, this is not double taxation because the legal legal persons are different. Once the profits are taxed in the hands of the company, it is the company which is a different juridical person which is paying taxes. And when the company is paying tax dividend to its shareholders, it is a separate taxpayer, right? So whatever income is being paid to as dividend to shareholder, it is obviously going to be chargeable to tax. Otherwise, you will say that company has earned income, so they should not be paying any taxes. It is not a case. I don't think that there is any constitutional challenge in this particular regard. And Supreme Court has also, I think, discussed all these cases in various judicial precedences, and they have not found any constitutional challenge, even in those cases when the dividend distribution tax was payable by the company itself. So in that particular scenario, even the same judicial person was paying taxes. So that was also not held to be unconstitutional. Any illegal business against public policy is also called a business and chargeable to tax under the income tax, as it includes adventure. Yes, sir. I think this is a statement. This is very correct. Illegal income from an illegal business, you cannot say that no, it's not chargeable to tax. It is definitely chargeable to tax. But please mind it that under section 37, any illegal expense is not deductible as expense. So any income from illegal business is chargeable to tax, but any expense against that illegal business will not be claimable as deduction. So in effect, what will happen is your gross profits will become taxable. G. Pradeep Kumar ji is asking, conversion of partnership firm into private limited company. In private limited company, balance sheet, share premium account balance is there. Is section 56(7)(b) attracts? Sir, I think we will have different separate session on other services, so this will be taken care in that particular case. Regarding compensation for trading contract, I'm not sure what you are trying to say. Will painting or sculpture, Sairam Chinni says, will painting or sculpture can be taken as profession as per section 44AA, even though not specifically mentioned in that section? Sir, I doubt, because if it is not specifically mentioned as profession, I doubt that this can be considered as a profession. It should be considered as business in my personal view. This is my personal view. What is tax is charged on profit, not on gross receipts. Amit Manglaji. Amit Manglaji, what is tax is charged on profit, not on gross receipt? I am not able to get this. Amitji, if you can clarify more in the chat box, it will be good. Then the next question is whether discrimination of illegal income made by Parliament and same within their jurisdiction by overrunning the settled principle of approbate or reprobate. Sir, Parliament can do anything. They are legislature, right? So they can make any law. That was, one must be very, very clear about it. Legislature has the power to create laws, and if you can prove that it is unconstitutional, they have the power to change the constitution also, right? In terms of when the GST was ruled out, they changed the constitution. So to my mind, income tax and revenue laws are very, very flexible. I am not very sure that what kind of unconstitutionality is brought in by bringing in tax on particular streams of income. So if someone is able to prove that this is unconstitutional, probably you are free to argue. But to my mind, legislature is very much free to bring in any law. If they feel that we are not going to allow illegal expenses, they can very well make it. And this is now a very old law. If the constitutionality would have been involved in this, it would have been argued or changed. See, the 2012 amendment, which was retrospective, which was brought in from 1961, that was not challenged by anybody that it is unconstitutional. right? They could bring in law from retrospective date of 40 years or 50 years back, and nobody dared to challenge it before the court of law, saying that it is unconstitutional, because the powers of legislature are very wide. So let's move on. Let's move on to other points. Some other key points which are related to section 28 are basically business income should be distinguished from income from employment, as we have already discussed. Obviously, dividend income is taxable under the head PG income from other sources, and dividend income is taxable under other sources only. It cannot be taxed under any other head because it is specifically mentioned under section 56. So even if a person, even if a company, or even if a person is in the business of investment, even if it is an NBFC, dividend income, if it is earned from any investment in shares, then it has to be taxed as other sources income. It cannot be taxed as PGBP. Third point, interest income on fixed deposits made out of idle or surplus funds are taxable under the income from other sources. There are various case laws, Tuticorin Alkali, Bokaro Steel, which are saying that interest income from fixed deposit meant for business. There are certain, these are exceptions. Tuticorin Alkali and Bokaro Steel are exceptions, but the general concept is that we generally bifurcate the interest income and charge it to tax under the head other sources, until and unless we can say that no, certain deposits were, say for example, if you made an earnest money deposit with a bank in order to apply for a contract, for a business contract, in those circumstances you can say that whatever income has been earned for that, from that particular FD, is going to be chargeable to tax as PGBP. Now, why this distinction is important, why it has to be very clearly made out whether it is chargeable to tax under the head PGBP or income from other sources, because if there are certain carry forward business losses, the same may not be able to you may not be able to adjust those carry forward losses against the interest income if it is chargeable under the head other sources. But if it is chargeable under the head PGBP, you can adjust the carried forward, brought forward losses against the interest income also. So therefore, it becomes important whether and how you need to classify the interest income. Then income from letting out of house property is generally chargeable to tax under the house property head wherever, however, the person is engaged in the business of letting out. They are in the business of leasing. In those circumstances, it can also be taxed as PGBP income, right? So income from letting out is business of the taxpayer. Income from letting out taxable under the under business income. It has been held in Chennai Properties and Investments, Karunapura Development and Company, Sultan Brothers, and various other cases. And in CBDT circulars number 16 of 2017, lease rent from letting out of building or developed space along with other amenities in industrial park or SEZ, it is also mentioned that it has to be taxed under the head PGBP. Also, there are a lot of tussle or in the mind which goes on whenever we are faced with an individual who is dealing consistently in shares and securities, who is frequently buying and selling shares and securities in stock market. Then the question arises then whether it is a business income or capital gain. In those circumstances, there are certain guidelines which have been prescribed by the CBDT, and it is only guidelines which have been prescribed. It is not something which is mandatory. The guiding principles which have been laid out is the one has to see what is the intention at the time of purchase, any act prior to purchase, making or showing a design or purpose. If it is a company, what are the main objects of those company? What is the treatment in your books of account? What is the method of valuation in your accounts? The quantum means how frequently or how regularly you are engaging in that particular activity. Ratio between purchase and sales. So means whether it is very consistent, you are regularly purchasing, you are regularly selling. Then someone may say that it is business, but you have purchased and then you are selling very less amount and you are holding it for a longer period of time. That can also lead to certain, guidance as to whether it is business or it is held for capital gains. then frequency, continuity, regularity of transactions, and whether it is possible to have two portfolios, one for investment, another for stock and trade. So in fact, we argued one case in the assessment proceedings last year in January and February, wherein the person had two portfolio. Actually, it was holding two stock broking accounts, one with one broker and other with other broker. And one broking account was held for investment purposes only, means whatever investments were made, they were very less frequently sold or purchased. Whereas in the other account, he was frequently trading and purchasing and selling. And then we argued that this particular broking account is for business purposes and the other one is for capital gain purposes. And that was accepted by the income tax authorities. So that is something which you can always argue. And also in the circular, it has been mentioned that an option has been given, that it is at the option of the SSC to say that whether it is my capital asset or it is my stock and trade. So, but it also says that once you have opted for stock and trade, then you must stick to it consistently. Once you have at the time of purchase classified as stock and trade in your books of accounts, then you must consistently follow it as stock and trade only. So there are certain permutation and combination which we need to see and assess while we are dealing with such situations. Now let's move on to certain other admissible expenses, which are generally specific sections 30 to 36 talks about certain specific deductions. First is section 30, which talks about rent, rates, taxes, and repairs and insurance in terms of buildings. Whenever you are carrying on business in a building in a particular premises, and expenses incurred in relation to those premises are classified under two predominant classification, wherever you are occupying that premises as tenant or where you are not occupying that as tenant, means you are basically the owner or you're not paying any rent. So when you are occupying it as tenant and you're paying rent, then obviously you can claim deduction for rent, and also the cost of repairs. Wherever you are owning the premises, in those particular circumstances, the repairs need to be current repairs. Now, what does current repair means? There is no definition provided in the act, but there in judicial precedents, it has been held that wherever you are recurring certain repairs and maintenance which are regular in nature, which are revenue in nature, all those are considered as current repairs. But whatever repair is providing you enduring benefit, or it is adding to the premises certain features or certain other benefits of enduring nature, all those repairs should not be considered as current repairs and therefore should not be claimed as revenue expense. So this is something which is very which needs to be taken care while claiming the cost of repairs. Now you would see that there are many restaurant chains or many franchisees which open up in rented premises. Say for example, a pizza corner, a kind of pizza chain is running, and they have taken a premises on rent, and now they prepare certain they install certain furniture and fixtures, they modify the internal interiors in certain way which has to be in their brand compliance. In those circumstances, there are a few judicial precedences which say that such kind of repairs or such kind of interior decoration or whatever the flexible furniture and fixtures they have installed in the rented premises can also be claimed as revenue expenditure, because ultimately they are occupying the premises only as a tenant, and whatever enduring benefit is going to happen, it is not for them, because they are going to leave the premises on as is basis whenever they move out. So there are judicial precedences wherein such kind of expenses have been held to be revenue in nature. So therefore, because these can be substantial expenses, wherever you are dealing with certain chains of food corners or certain kinds of franchisee operators, wherein you set up those franchisee and incur expenses, all those expenses can be claimed as revenue expenditure. Obviously, there will be certain certain expenses which might not be available as revenue. Say for example, if you have installed an AC unit in that particular premises, or you have installed a plant and machinery or a kitchen, plant and machinery in that particular kitchen, those expenses might not be available as revenue, but you have to be careful and you need to see the judicial precedences that whatever expense you can claim as revenue, you should claim as revenue, because ultimately it can give much needed expense to the company in the year of expenditure itself, right? So then the other provision of section 30 says that what are the general expenses which can be claimed if you have paid any land revenue, local taxes, municipal taxes, if you are any premium of insurance you have paid in respect of that particular building premises, then that can also be claimed as expense, revenue expense. Now, obviously, as I mentioned, cost of repairs not to include expenditure of capital nature. Particularly, you need to see, as I mentioned, if there are expenses which can be claimed as revenue expenditure, wherever you are a tenant, that you need to see as per the judicial precedents. Then further it says expenditure which is not covered under section 30 may nevertheless be allowed. It can also be allowed if they satisfy the conditions for general deduction under section 37. So it is not that whatever expense has to be allowed in respect of building or premises has to be allowed under section 30 only. If there are general expenses which you have incurred, that can also be claimed under section 37, but it should be seen that it should not be specifically disallowable under 30. If it is specifically disallowable under 30, then you cannot go and say that now it is allowed under 37. Premium payable for acquisition of lease rights is not considered as rent and is not allowed even over the life of the lease. So lease rights are generally a peculiar subject. If you have taken a land on lease for a long term, say 30 years or 40 years or 50 years, many times earlier people were claiming the lease rent over the lease premium which they used to pay over the period of the lease term. But now it is not allowed. There is a specific mention that you cannot claim it as revenue expense even over the period of life. Moving on to section 1, it talks about repairs and insurance. It's a very normal clause in terms of allowable expense for plant and machinery or furniture. It says deduction is allowable for current repairs, insurance premium paid in respect of assets. The earlier section was in respect of building. Now 31 is in respect of plant and machinery and furniture. Then it says principle laid down in Sarvana spinning mills by Supreme Court. It says expenditure must be to preserve and maintain an already existing asset and not to bring a new asset into existence. And as we all know that if the expense is to bring into an existence a new asset, then it will be a capital expenditure, right? So whatever expense you are incurring to maintain the asset will only be classified as revenue expense, which is claimable under section 31. Then it says even if machinery forms part of larger process, if it is able to operate independently, expenditure in replacing it would not be current repairs. So what it would be capital expense, because ultimately if it is a significant part of your process and you are replacing it, say for example there is a large production line and in that your production conveyor belt is to be replaced. So conveyor belt replacement of conveyor belt may not be said to be current repairs. It might be replacement of a particular asset itself, and therefore it might be required to be capitalized as a cost of asset. Substitution of old parts with new parts would usually be current repairs, except substantial substitution or improvement which changes the identity of the machine. So in my example of conveyor belt, so conveyor belt is going to give you a longer life to the plant and machinery. But if it was a particular screw or a particular part of the machinery which has to be replaced or which has got malfunction and a spare part has been put in place, that can always be classified as revenue expenditure. Non-current repairs are allowed as deduction under 37 if they are revenue in nature. So these are very thin lines, obviously depend on facts of case to case. We have to see and apply our judicial, our professional judgment in order to see whether it is revenue in nature or not. Now coming on to depreciation. We'll take the queries little later. Let's move on to depreciation. So first of all, depreciation on tangible assets. It is dealt with in section 32, subsection 1, clause I. It says depreciation allowance is confined to buildings, machinery, plant, and furniture. Depreciation is not allowable on land. Land is always an appreciable asset as per the law. Law views that land is always going to appreciate. It's not a depreciable asset, and therefore no depreciation is allowable. And depreciation to be provided on return down value method, wherein, say for example, 100 rupee depreciation is 15, that next year depreciation will be allowed on 85. Then on next year depreciation will be allowed on the reducing balance basically. So depreciation rates have been revised in new appendix 1 to rule 5 under the income tax rules 1962. Different rules and rates for power generation and distribution undertakings. Basically, these kind of companies, power generation and distribution undertakings, they are allowed to claim the depreciation on straight line basis also. So there is only one exception wherein straight line depreciation is allowed, which is for power generation and distribution undertakings. Also, you would have seen in earlier years, a lot of assets were depreciated at 80% or 100%, right? Or 60%, a lot of computers, and they were depreciated at very high rates, or renewable energy power equipment. Those were clean energy equipments, all those were depreciated at 100% or 80%, very high rate. So with effect from 1st of April 2018, the government has restricted that whatever is the rate written in the rules or the appendix, the maximum rate which will be allowed as depreciation is 40% on a return down value basis method. And if the higher rate is mentioned in the schedule or appendix, it will not be considered. The maximum threshold is 40% only. So this was done with effect from assessment year 18-19, and now we all know this has to be reported in the depreciation schedule also. And however, if the asset has already been depreciated, then as 100% only, then nothing to be done. Then ICTS 4 talks about recognition of tangible assets. What is the cost you have to be considering? Then it says tangible fixed assets shall be recorded at actual cost, including purchase prices, taxes, excluding those that are recoverable. Means if there is SENVET available, if there is input credit available, then probably you can exclude it, but otherwise not. And any other expenditure for bringing the asset to a workable condition. All these expenses have to be clubbed and capitalized in the cost of the asset for income tax purposes. Then it says administration and general overhead shall be excluded from actual cost if not relating to specific asset. Say for example, if there are administration people engaged in coordination of the efforts, then we may not say that the salary cost or certain other administration expenses should also be allocated to the capital cost. It's not mandatory. It's not required as per law. So if there are general administration expenses and general overhead, you can exclude it until and unless you absolutely know that this particular overhead is only for this particular asset, and only in those cases you will have to capitalize it. Expenditure on startup and commissioning of a project shall be capitalized, while expenditure post commencement of commercial production shall be expensed off. Tangible asset shall be recorded at its fair value if acquired for non-monetary consideration. Means if it is acquired for certain other value which is not quantifiable in monetary terms, then in those circumstances you have to determine the fair value of a particular asset, and then the consolidated price for acquiring group of assets shall be apportioned on fair basis. Say for example, in slump sale, the group of assets is acquired. In those circumstances, fair value has to be applied, and the cost has to be recognized. There were certain rules which have been prescribed in case of slum sale also, which will not talk about in detail as of now. But certain mechanisms might be available to particularly assign the value to a particular asset in case you have purchased the group of assets and not a singular asset for a lump sum consideration. This can be done even without slum sale. Means you have not purchased a full business undertaking, but you have just purchased a set of 5 or 6 assets for a lump sum consideration. Even in that case, you need to assign a fair value to each asset. Right? Then the other conditions used for purpose of business or profession. Obviously, this is one of the very basic conditions, that the asset on which depreciation is being claimed must be used for the purposes of business or profession which we are carrying. Asset should be actually used and not just be ready to use. There are certain judicial precedents which also say that if an asset is ready to use, say for example, there was a case of a bus in a school which was always kept ready for use but was not actually used. In those circumstances, the depreciation was still allowed. So this is also something which we need to see on a very fact-to-fact basis, and it might be a position where you might be able to say that if the asset is kept ready for use for the purpose of business only, then depreciation should be allowed. And it is sufficient if asset is used even for a part of the year. It should not be, it is not mandatory to be used for the entire year. Depreciation may be allowed even in case of assets that are not actually worked in whole year, such as assets kept on standby, right? So that is the position which I was referring to. So there can be an overlap between first condition and the second condition. So you need to see whether the asset is on standby or it is just kept idle. Then even if a machinery is used in an earlier previous year, depreciation should be allowed in the later years, right? Discarded machinery need not actually be used in particular previous year. So if you have discarded a machinery, what happens? Now we have a concept of block of asset. So even if the machinery is discarded, but the value has gone into the block of asset, the depreciation will continue to be claimed, right? So until and unless it was sold, the sale consideration would get reduced from the WDV. But if it is just discarded, the depreciation will continue to be claimed. But it has to be used once. At least once it has to be used for the purposes of business. Then it will move into the block of assets. Then last it says, in case of leases, depreciation is allowable to the lessor. ICDS Limited. This was the case of finance lease generally. Many times in finance lease, in the books of accounts, the lessee tends to recognize it as an asset. Under ICDS also, many times it happens that for a long-term lease, the asset is recognized as an asset in the books of accounts of the lessee. But for income tax purposes, there is no concept of finance lease or operating lease as such. There used to be a controversy, but now with this particular judgment of ICDS, Supreme Court has clarified that in the cases of leases, depreciation has to be allowed in the case of lessor only. So who is the legal owner of the asset? Depreciation has to be claimed by them. Right? So as we mentioned that ownership is very important in case of depreciation. You have to own those assets. But ownership may not be legal ownership. Say for example, in terms of cars, many times what happens is the car is registered in the name of director, but ultimately the de facto ownership is of the company only, right? But only for the registration purposes the car was registered in the name of director. In those kind of circumstances, we have to see who is the de facto owner. If you are the de facto owner, you can very well claim the depreciation. The person who has the right to receive income from the asset should be treated as owner. As per explanation 1 to section 32, it provides that in respect of leasehold premises where any capital expenditure is incurred for construction of a structure or any renovation or improvement or extension, depreciation would be allowed as if building is owned by the taxpayer. So say for example, when I was giving the example of franchisee in a leased premises, and you have installed an AC unit, or you have installed a kitchen or you have installed a capital asset in that particular premises, even though the building premises are not owned by you, but those assets are owned by you, in those circumstances, depreciation shall be allowed to you. Then it says company would be allowed depreciation on car registered in the name of director, as I've already mentioned. Then moving on to depreciation on intangible assets. Intangible assets, what does it include? It includes know-how, patents, copyrights, trademarks, licenses, franchises, or any other business or commercial rights of similar nature. Now, any other business or commercial rights of similar nature was very wide. And in terms of interpreting this particular item, the courts held that goodwill is one of the rights which is commercial right or which is in the similar nature, and therefore in terms of any slump sale or even in the case of amalgamation, in one or two cases it was held that whatever goodwill is arising to the purchaser, it shall be treated as an intangible asset. Now there was a lot of controversy around this particular subject, that whether goodwill is to be allowed as depreciation or not, and predominantly the assessees were claiming depreciation on goodwill, considering it to be an intangible asset. Now with Finance Act 2021 and with effect from assessment year 21-22, so basically 1 year retrospective kind of an amendment, from assessment year 21-22 means from financial year 2021, depreciation on goodwill is not allowed. Now they have put it in section itself. They have mentioned that whatever they have mentioned a clause saying that tangible asset, intangible asset licenses or this, but not including depreciation on goodwill. So they have clearly mentioned it. They have also excluded depreciation from the definition of intangible assets. And therefore, if you were claiming any depreciation and you have included goodwill in the block of assets, you have to extract it now. How you have to extract it? You have to see that whenever you had purchased it, from that year, you have to compute 25%, or if it was for half year, then accordingly, you have to compute that depreciation till assessment year 2021, whatever has been claimed, you derive a WDV of that particular goodwill, and then that goodwill WDV has to be reduced from the block of assets now, and on the remaining WDV of intangible assets, you can only claim the depreciation. So now this controversy has been put to rest, basically. Even in terms of a slump sale, wherein goodwill has to be was arising as a residual asset, now goodwill is not to be, it's kind of a dead loss. So if you are acquiring a business in a slump sale and you are making a payment over and above the fair value of the assets of a particular company or a particular business undertaking, in those circumstances, the goodwill which used to get recognized in the books of accounts will not be considered as a depreciable asset now. So what is how you can go around it? If you would see that there are a lot of intangible items which are written in the business contracts, these business transfer agreements, generally BTA, which we call, there are specifically mention of, say for example, contracts, say for example, employees, say for example, skills of employees, the long-term nature of the employment contracts, or certain technologies which are owned by the company, or certain other approvals, business approvals, right? For trading into particular goods and services, there are certain government approvals which are required. So if those government approvals are being transferred along with the business, those those assets now need to be specifically valued, and particular assignment of a value must be done in the business transfer agreement, or at least in your valuation report of your assets. You must identify all those intangibles which are specifically mentioned in the business transfer agreement and assign a value to them. And in those particular circumstances, you can say that goodwill is what? Goodwill is basically the name of the business. So if you are able to identify your intangible assets, particular intangible assets in the business transfer agreement, and assign a monetary value to them, and reduce the value of goodwill in the books of accounts, then you can still claim depreciation on those particular assets because goodwill is not defined in the act. As simple as that. So whatever you mention as goodwill in your books of accounts or in your business transfer agreement or in your valuation report after the acquisition of a particular business undertaking, the government is going to take a clue from there only. If you are able to specifically identify certain business or commercial rights and assign value to them, you can probably still claim depreciation on those items. So therefore, all is not lost in mergers and acquisition businesses or transactions. You can still find a way out of claiming depreciation on such intangible assets. Right, so moving on to additional depreciation. Additional depreciation, as we all know, over and above the rate of 15% of depreciation on plant and machinery, you are allowed additional depreciation of 20% on the cost of new machinery and plant if it is engaged in the business of manufacture or production of any article or thing in generation, transmission or distribution of power. This is basically under section 32(1)(2)(a). It also says that 50% of additional depreciation will be allowed in first and second year, where the machinery or plant is put to use for less than 180 days. So for example, if you are engaged in manufacture and production and you purchased a new plant and machinery in December. So by the virtue of the nature of depreciation, you will be allowed only 50% of the depreciation because it is less put to use for less than 180 days. Now what used to happen is that out of this additional depreciation also 10% used to be allowed in the first year, and many people used to claim 10% in the next year. But there was a litigation or controversy from the income tax authorities side that they did not used to allow the 10% depreciation in the second year. They used to say that additional depreciation is only allowed in the first year of the put to use, and therefore we are not going to allow you the balance 10% in the next year. So they amended the provision. The government said that yes, it is a genuine hardship, we must allow you. So additional 10% of depreciation was also allowed in the second year or the subsequent year in which the asset was put to use. Right? Now it also says that additional depreciation is not allowed in certain circumstances where the asset is used before installation by taxpayer either within or outside India by any other person. Asset is installed in office premises or residential accommodation. So basically this additional depreciation is aimed to give benefit to manufacturing entities and for manufacturing capital assets only. Office appliances or road transport vehicles, these are not allowed for additional depreciation, even though they may classify under the broad head of plant and machinery, but additional depreciation is not allowed there. Or the whole of the cost of asset is allowed as deduction in any one previous year. As I mentioned that earlier, there used to be 100% depreciation allowable on certain assets of clean energy or certain other provisions. Or if you are in specified business or you are engaged in capital research and development and the capital asset was purchased for for research and development purposes. In all those circumstances, 100% of depreciation or deduction is allowed in the first year of purchase itself. In those circumstances, there is no concept of additional depreciation. Right? Now, there are certain special provisions in the Income Tax Act, such as Section 115BAA, 115BAB, 115BAC. They are either 22% of lower tax, or for manufacturing entities of 15%, or for individuals and HUF where they can claim higher thresholds, right, up to 15 lakh without deductions. Or in all these circumstances, in all these sections, additional depreciation is not allowed, right? So if you are claiming these special provisions, if you are paying taxes under these special provisions, you cannot claim additional depreciation even if you are qualifying or classifying for all these conditions. So this is one benefit which has been taken away, because they are saying that we are taking tax on at a lower rate from you. We are not going to allow you certain additional benefits. So therefore, one must be very careful that whenever you are availing special rates under special sections, additional depreciation is not allowable. Then in certain backward areas, there was a provision of additional depreciation of 35% instead of 20% in West Bengal, Bihar, Telangana, Andhra Pradesh for the period if the capital asset was put to use between 1st of April 2015 but before 1st of April 2020. Right, so this may be available to you in earlier years if you are dealing with certain such companies. Now let's see if we have certain queries here. What is the difference? Anonymous attendee is asking, what is the difference between current repair, accumulated repair, and replacement? Sir, accumulated repair, I'm not sure what do you mean by accumulated repair, but current repair is basically revenue in nature. So whatever is in the running of the business, you have to just repair it, the repair maintenance kind of a thing which you have to do. That is called current repair. Whereas replacement is somewhere where you are replacing the furniture or fixture or the plant and machinery, or which might bring in enduring benefit and some capital benefit to you. In those circumstances, it might be considered as capital expenditure rather than current repairs. So replacement also might not be every replacement might not be capital expenditure. So you have to apply your professional judgment to understand whether it is bringing in certain enduring benefit or not. What is the rationale behind not allowing premium on lease as deduction? Sir, as I mentioned, generally premium on lease is basically the government says that it is an appreciable right. So premium on leases, generally they say that it is a right which is going to appreciate only and it's not going to depreciate. Also means this might be one of the reasons, but I'm not very sure. Predominantly it was brought in for the leases of land. So in terms of lease, a rent which has been deducted over the period of lease. So in this, according to you, the replacement of conveyor belt is not current repair, mainly because of substantial fault compare with other small parts. Is it principally legal or not? I have not agree with this view. Sir, you are free to have your views. I just give an example. As I mentioned that in terms of particular facts and circumstances, you may have different views. How the depreciation policy formulated by legislature, can you explain it? Sir, depreciation policies, generally the legislature considers that what can be a general life of an asset particularly, and whatever is the life of an asset, it's just an estimate basis. It may vary from an asset to asset. Even in plant and machinery, one might say that 15% depreciation is very low, but it is for the legislature to decide, and in their wisdom they have decided that these are particular rates of depreciation which generally define the estimated life of a capital asset. So that is how they have brought in all these rates. Say for example, 10% on building, 15% on plant and machinery. When there was a case that laptops and computers were getting obsolete at a very fast pace, so they brought in the depreciation rate at 60%. But unfortunately, now they have restricted it at 40% for all the asset, the highest rate. So how legislature, whatever legislature feels that it is a particular life of an asset, they generally prescribe the depreciation rate accordingly. Is ICDS is legalized by statute, and if yes, then under which clause, and if ever anybody challenged before judiciary? Yes sir, it was challenged before the judiciary, I think by chambers of tax consultants or someone, and there was a ruling also pronounced by Delhi High Court, I think in November 2017 or so, wherein they had struck down a few few provisions of ICDS saying that these are not as per the provisions of the law, and just by a notification you cannot override the general provisions of the law. So in order to bring in all those provisions, they have amended respective sections, predominantly section 145, and wherever it was required, wherever, say for example, in section 224 also, in many sections, many provisions, they brought in amendments from retrospective effect. I think you can find it in Finance Act 2018. I think so. I think it was Finance Act 2018. You can find it there. All these provisions related to ICDS, whatever was provided in the, whatever was the judgment which said that this is not in the Act, this is not in the Act, they provided all those provisions in the Act itself. So now ICDS has got legal backing. Almost all the provisions of ICDS are now backed by the provisions of law. Why two depreciation policy prevailing under India, under Income Tax Act, under Companies Act? Sir, what can I say on this? Income tax is governed by Ministry of Finance. Companies Act is governed by Ministry of Corporate Affairs. There are two ministries, they have two views. Income tax says that we want more revenue, so they generally prescribe lower rates. They prescribe on the basis of the what they feel is the right depreciation. Companies Act deal with the companies law provision. So please be aware that under Income Tax Act, it is not just companies which are getting taxed. There are individuals, there are HUFs, there are partnership firms, there are so many other entities, trusts, and so many other entities who are not liable or who are not governed by the provisions of Companies Act. So therefore, in those particular circumstances, the rates of depreciation are generally commensurate with the Income Tax Act rate only. So therefore, just to compare and to find that rates between Companies Act and Income Tax Act are different, it might not be a good idea, because you may find similar differences in all other countries also. Right? So Companies Act is generally the rates there are for the stakeholders. The rates prescribed are for the investors, for the shareholders to understand the performance of a particular company. Wherever the rates of depreciation prescribed under income tax are also somewhere influenced by the will of revenue to collect more taxes, right? So therefore, they have to be, the revenue has to balance it, but there are bound to be differences. Why depreciation is not allowed for a proportionate period irrespective of irrational system of 180 days like Companies Act? Sir, it is for your benefit only. It makes the calculation of depreciation very, very simple as compared to the Companies Act, wherein you have to calculate on day-to-day basis. So this criteria of 50% of for assets put in for less than 180 days is basically to simplify the process of calculation of depreciation, nothing else. What is the tax? What is tax is charge on profit, not on gross receipts. I don't know what is this. Sir, 2T crore alkali, we have mentioned, I think, I have put it in the judgment. I have put in the judgment in the PPT thereafter. So let's move on, because we have to cover many other things also. Unabsorbed depreciation. It talks about wherever the depreciation of a year cannot be absorbed by income of that previous year due to insufficiency of income, the unabsorbed depreciation of unabsorbed portion of depreciation is treated as depreciation allowance of the succeeding year. So what it means is that depreciation becomes the depreciation of the next year. Unabsorbed depreciation can be carried forward for indefinite period because it gets renewed every year. So if it is not absorbed in 1 year, it subsequently becomes a depreciation of the next subsequent previous year. So in that effect, it gets a renewed life every year. So therefore, there is no limitation on the claim of unabsorbed depreciation. So for example, in the cases of business losses, you can carry forward for only 8 years, or for other some short-term losses, you can carry it forward for 4 years. right? So similarly, there are restriction on carry forward of losses, but for unabsorbed depreciation, there is no such limitation. Unabsorbed depreciation can be carried forward for infinite period of time and can be adjusted against income under any other head of income other than salaries. Why? Because it becomes business loss every year. So business loss can be set off against any other income. It is to be adjusted against current year income after adjusting carry forward of losses. So basically what happens is that even though it becomes next year's income, next year's depreciation, but the precedence is given to adjustment of brought forward losses rather than to unabsorbed depreciation brought forward from the previous years. So therefore, even though it becomes the depreciation of the next year, but yet the precedence for adjustment of losses is given to the brought forward losses because they have a definite life. So therefore, they must be adjusted first, and law understands that. Unlike carry forward of business losses, unabsorbed depreciation can be adjusted even if no business is being carried on by the taxpayer, and even if taxpayer no longer owns the asset. So business losses cannot be set off if you have stopped the business, but unabsorbed depreciation can still be carried forward and adjusted. Section 79D, which debars carry forward of losses in case of certain changes in shareholding or voting power, is not applicable to unabsorbed depreciation. So section 79 says that if your shareholding is changed by more than 51%, say for example in year 1, A and B were holding shares, but in year 2, when the brought forward losses are to be set off, A and B have moved out and C and D have come in. So the shareholding has changed. So the law section 79 says that now this company cannot set off the brought forward losses because the shareholding has changed by more than 51%. However, this particular provision is not applicable on carried forward of unabsorbed depreciation. So unabsorbed depreciation is not affected by change of ownership. Also, filing of return within the due date is not necessary for carrying forward of unabsorbed depreciation. Investment allowance, let's move on because investment allowance is not, I've mentioned it in the PPT, you can read out on your own. Let's move on to certain other important things. Section 35 also, this is, I'll not spend too much of time. It's on expenditure on scientific research, basically under subsection 35, section 35(1)(1). Even capital expenditure on scientific research can be claimed as expense in the year in which it is incurred. It is not to be capitalized. Depreciation should not be claimed. It can be claimed as basically revenue expenditure, right? For similarly, salary to employees engaged in scientific research and purchase of material capital expenditure during the 3 years preceding to commencement of business is to be allowed in the year of commencement. So if you are engaged in research and development prior to your commencement of business, and then you commence your business in that year, for the expenses incurred prior to 3 years prior to your commencement, you can claim that entire expense as the expense in the year of commencement. Then 35(1)(2), it was weighted deduction basically for certain donations which was made. Now with effect from 1st of April 2021, basically it is restricted to 100%, which is the amount of donation you have made. The amount paid to approved Indian company having main object of scientific research and development also, in this particular circumstances, you can claim the amount of donation as your business expense. Now, why these have been mentioned here is because generally donation made to other person is not claimable as an expenditure because it is not related to your business. But to promote research and development, such kind of donations are also allowed as business expenditure in the hands of the donor. Now there is one amendment which has been made, which I have not mentioned, that see these kind of institutions or universities were earlier recognized perpetually, forever. Once the recognition was given, it was given forever. But now the amendment has been made that these institutions will be re-recognized, and they will be re-recognized for a batch of 5 years only. So after 5 years, they'll have to re-approach and get their registration renewed. So this is to basically keep more hold and keep tab on the activities carried on by these institutions. which we have also seen for charitable trust. Now you have to go every 5 years for claiming your registration. Now let's move on. 3580. 3580 is an important section because it talks about 100% of capital expenditure being allowed as deduction if you are carrying on certain specified businesses. Now, what are these specified businesses? These are operating a cold chain facility, warehousing facility, natural gas or crude or petroleum oil pipeline, hotel, hospital, housing project, right? Fertilizer, production of fertilizer, beekeeping, inland container, setting up of operating of warehousing facility, laying or operation of slurry pipeline for transportation of iron ore, splitting up or setting up or operating a semiconductor wafer fabrication and manufacturing unit, or developing or maintaining and operating or developing and maintaining and operating a new infrastructure facility. So basically, if you would see, these are all kind of predominantly such kind of businesses which are capital intensive in nature. They require heavy capital investments, and therefore in order to incentivize these businesses, this section was introduced and provided that 100% of capital expenditure for this particular new business can be claimed as deduction in the year of expense itself. Now, earlier there used to be somewhat hesitance in terms of taxpayers, because these are capital intensive and many times it takes many years to get profits in business in their books. So they did not used to earn taxable profits very soon. So what happens is that if this capital expenditure is allowed as deduction as a revenue expense in the year of expense, it becomes part of the business losses. Whereas if this capital expense is capitalized as cost of assets and intangible asset or whatever assets they are, whatever depreciation is to be claimed, that depreciation will remain unabsorbed depreciation, and that can be carried forward for a number of years. So what happened was, many companies who were engaged in these specified businesses were not claiming it. However, there was some controversy wherein the income tax officials were forcing the companies to opt for this particular section, or they were saying that this is the language of this particular section was such that it appeared to be mandatory in nature. However, the assessees used to say that it is a beneficial provision and we should be given an option. So in order to remove all those barriers and to give an option to the assessee, it was specifically mentioned in the option that the provisions will be applicable only if the assessee opts for it. But once the assessee has opted for, say for example, if I have put in a fertilizer factory in year 1, so if I have opted for that particular provision in year 1, then my business will be specified business. Then if I have to extend it, if I in any further year I incur more capital expenditure, then I'll have to claim that expense as deduction only, because I have opted for my business to be considered as specified business. Therefore, one has to be careful in calculating their future projections in terms of profits and whatever they want to earn, whatever they are projecting to earn, in order to opt for these provisions. So what are the conditions which are applicable to this claim? Say there can be gestation period of 2 to 3 years or many years before you put up a specified business. Say for example, if you are putting a hotel, you're building up, constructing a hospital, or you are putting up a fertilizer factory, it may take a few years time. So in that case, whatever expense you have claimed as you have incurred as capital expenditure can be claimed in the year of commencement. Say for example, if it takes 3 years, then whatever expense you have incurred in 3 years can be claimed in year 3, in which the operations are commenced. Whereas after the commencement of operations, you can claim the capital expense as and when you are incurring it during the previous year. Obviously, this Exclusivity has to be there, means entire expense has to be incurred for specified business only. And also the expense should not be incurred in by way of cash. It should be either by electronic mode, account pay check, or whatever modes which are specified, but not through cash, or not through even what I say, non-account pay check also will not be considered. Then it says that what if there is loss in specified business? So if there is a loss, you can carry it forward, but this loss can be set off only against the profit of specified business, right? So you cannot, if there are multiple businesses in a particular company, one of them is specified business. If loss is incurred in the specified business, that can be claimed only against profit which are earned from the specified business, not from the profits of other businesses, right? However, one important thing is there, similar to unabsorbed depreciation, the losses of specified business can be carried forward indefinitely. And this is provided in section 73A. Then it says business, obviously specified business should not be splitting up of an existing business. Your plant and machinery should not be old plant and machinery. No deduction shall be allowed under section 10AA or chapter 6A in respect of this business. Right. Let's move on. Amortization of preliminary expense, 35D. This is very common section which we generally see. Deduction is only for resident taxpayer. It is allowed over a period of 5 years. Basically, 1/5, you can claim it over 5 years. It is not allowed in the year of expense itself. It has to be deferred. Basically, this is one of the few expenses which are allowed on the basis of deferred basis. On preliminary expenditure, so preliminary expenditure is defined. Whatever is expense which is defined here can only be considered as preliminary expense. And if it is incurred before commencement of business, then you can claim it as 35D expense over a period of 5 years. Now, but if you have already commenced the business and you are incurring certain expense after the commencement of business, then it has to be only in connection with the extension of undertaking or setting up of a new unit. If the expense, if these preliminary expenses are in respect of extension of business or setting up of a new unit, only then you can claim it as normal expense over a period of 5 years. Otherwise, what might happen is that it may get disallowed fully. Right? If it is for setting up of a new business unit, then it might be a case that this gets disallowed and not claimable as even revenue expenditure under section 35, because these are specifically mentioned as preliminary expenses under section 35D. Now, what are the preliminary expenses? Preparation of feasibility report, preparation of project report, conducting market survey or any other survey necessary for business of SSC, engineering services relating to business of SSC, expenditure such as legal fees for drafting of any agreement, registration of company, issue of public subscription, expenditure on printing of MOA or AOA. All these expenses are classified as preliminary expenses and should only be claimed over a period of 5 years under section 35D. Now, what is the extent of this particular expense? Say, for example, if your cost of project is, say, for example, 1 crore rupees. So all these expenses clubbed together cannot exceed 5 lakh rupees. So if you have incurred 6 lakh rupees, your 1 lakh rupees means 6 lakhs minus 5 lakh, 1 lakh will be disallowed. It will be a dead loss. It cannot be claimed that, okay, 5 lakh is allowable under 35D. Now 1 lakh balance amount, we will claim it under section 37, right? So that should not be the case. Or the cost of the project or the capital employed. So 5% has to be seen either through the cost of project or the capital employed by the company. Now, one more thing I wish to mention here is that earlier 35D used to be only allowed expense. It used to be allowed only to manufacturing units. But now, I think in Finance Act, I don't remember exactly which Finance Act it was. I think it was somewhere in 2012, 13 or 14. wherein it was mentioned that now this expense can be claimed by any business, even by the service companies. So even if there are service companies which are engaged in extending their business or which are incurring significant expenses in this particular respect, they can claim 35D expense in their income tax computation. Say for example, I was handling a case of NBFC. They had increased their paid up share capital from 100 crore to 300 crore rupees. Now for increase of this 200 crore rupees, they incurred significant ROC fees and significant expense in terms of increase in authorized share capital. So all that expense was claimed as a 35D expense, because now it was allowed to even service companies, because they were extending their business. Obviously, how NBFC can extend their business? By increasing their share capital, by increasing their capital under control. So that is where we claimed it, and it was allowed in the income tax assessment. Let's move on to certain other deductions under section 36. Also, there is a long list of deductions which has been provided. First is the deduction for bonus. Just give me 2 minutes. Right. So first deduction under section 36 is for bonus. Bonus or commission payable to an employee for services where amount is not payable to him as profits or dividend. Basically, this clause is to prevent characterization of payment of dividend as bonus wherever the shareholders or the investors are also employed by the company as employees or directors. They may come up with certain clauses which says that we will be paid bonus if the company earns this much of profit, or we will be paid certain commission on the sales made by the company. So all those situations we need to see very carefully. We need to see whether that could have been classified as dividend, because ultimately shareholders are entitled to dividend. So until and unless such bonus or commission is directly commensurate or can be directly linked with their employment activities, it should not be allowed as deduction. If it is purely to compensate their investment in the company as shareholder, that has to be disallowed, as this will not be claimed as bonus, because this would have been distributed as dividend only. Now, deduction of bonus and commission is also subject to section 43B. We all know 43B is deduction of expenses on payment basis. Wherever the payment has been actually made, only then bonus and commission will be allowed as deduction. Sum paid to employee as bonus or commission which was otherwise payable as profit or dividend is to be reported in the tax audit report also. So obviously, as chartered accountants, we need to apply our professional judgment to see and evaluate the terms of the contract, whether it is classified as such or not. Then the second amount which is allowed under section 36 is interest on capital borrowed. Basically, it allows the interest on capital borrowed only after the asset has been put to use. It says that the proviso to section 36(1)(3) says that interest paid on capital borrowed for acquisition of asset is not to be allowed as deduction from the date on which capital was borrowed to the date on which such asset was first put to use. Now, before amendment, this particular text which is striked out right now was also mentioned in the proviso. So what it meant was, many taxpayers used to claim that we have not put up any extension of our existing business. It is just a new purchase of a new plant and machinery. They used to say that it is generic purchase, and whatever was the interest, they used to say that we have already commenced our business operations, right? And therefore we'll claim the interest as deductible expenditure if it is not related to extension of an existing business or profession. Now this particular text has been deleted, and therefore now for any purchase of asset, whether it is related to extension of existing business or not, it would be classified as capital cost till the asset is put to use, right? So this is the effect of the amendment. So then it says, with effect from AY 2016-17, so long as capital is borrowed for acquisition of asset, interest is not allowed as deduction till the date asset is first put to use. After the asset has been put to use, interest amount has to be allowed as revenue expenditure only. ICDS 9 also talks about the treatment of borrowing costs. Borrowing costs which are directly attributable to acquisition, construction or production of a qualifying asset shall be capitalized as part of cost of asset. Now a qualifying asset is defined under the ICDS 9 to mean those assets which take more than 12 months to get into shape or to get into existence. So ultimately, until and unless your asset is a qualifying asset, these provisions of borrowing costs shall not apply. Right? So we have to be very careful while reading the provisions of ICDS. So they have provided these two formulas. If the borrowing is a very specific borrowing, so for you have taken a loan from the bank, say for example, for construction of that particular asset only, then it has to be capitalized. There is no two way around it. Even if it is qualifying asset or not qualifying asset, it doesn't matter. Till that date of asset is put to use, the interest cost has to be capitalized. Wherever, however, if it is a general borrowing, you have not taken it specifically for a particular construction of asset, but it was a general borrowing, but some out of that borrowing, you have diverted some funds for the construction of asset also. In that particular circumstances, you need to see whether it is a qualifying asset or not. And if it is a qualifying asset, then the borrowing cost which need to be capitalized has to be calculated as per this formula, which is A into B divided by C, general borrowing cost multiplied by average amount of qualifying assets, that is asset funded out of specific minus asset funded out of specific borrowing, because whatever specific borrowing was taken, interest has already been capitalized to that extent. And obviously when the asset has been specifically funded through specific borrowing, that portion cannot be funded through general borrowing. So therefore that amount is reduced. And then C means average amount of total assets minus assets funded out of specific borrowing. So this is the formula which you need to apply to arrive at the amount of borrowing cost which needs to be capitalized as per ICDS 9. And moving on to next amount, it says about employers' contribution to various funds. So we all know that there are two components. One is employees' contribution, one is employers' contribution. So first we'll talk about employers' contribution. The contribution made by an employer to following funds are allowed as deduction: recognized provident fund under 36(1)(4), new pension scheme referred to in 80 CCD, which is section 36(1)(4)(a). Contribution up to 10% of basic salary is allowed. If you are contributing more than 10% of the basic salary, that amount is not going to be allowed as deduction. Then if you are making a contribution to approved gratuity fund, that is allowed under 36(1)(5). Such employers' contribution is allowed on payment basis, obviously. 43B, all these deductions are subject to provision of 43B, which talks about that it is not allowed on an accrual basis. The employer has to actually make the payment to those funds in order to claim such expense. Now, deduction of employer's contribution to various other funds, any sum received by employer from his employee as contribution. Now we are talking about employee's contribution, so please excuse the heading. Now we are talking about employee's contribution, means if there is 12% of PF which the employer deducts from the employee's salary, and then it has to be paid to the provident fund authorities. That amount is first included in my income. If you remember, under section 224, this is first included in my income, and then when I pay it to the authorities, it is allowed as deduction. So it says that any sum received by employer from his employees as contribution toward provident fund is deemed to be income in the hands of employer, 224(10). Such amount received from employees is allowed a deduction if it is credited to the amount of employee on or before the specified due date in the relevant statute. This is what is written in section 36(1)(5)(a). However, there were certain judicial precedents which I don't know why they just purely just ignored the actual language of 36(1)(5)(a), and they somehow correlated the employees' contribution also to employers' contribution, and they equated this amount to 43B payments, and then said that even if it is paid before, on or before the filing of the due date of tax return, even then you can claim it. So there were a plethora of judgments in order to justify these particular transactions, and say that even if it is not paid within the due date of the relevant statute, say Provident Fund Act or the Gratuity Act or whatever act it's payable, but paid before the filing of return, you can still claim it. Kerala High Court in the case of Marchim and Gujarat State Transport held that 43B does not employ. So there were a couple of judgments which were contrary also, but predominantly we had seen that there were judgments which were coming in the favor of the SSC. Now, in order to put that controversy to rest, a clarificatory amendment has been brought in by Finance Act 2021 to provide that deduction under section 36(1)(5)(a) is allowable only if the payment is made within the prescribed timelines under the relevant act, under the relevant statute, and it cannot be equated with section 43B. Now a controversy now again arises as to what happens to the earlier years, means whether it is applicable on retrospectively or not, because what we have seen prior to this amendment also, under section 143(1), when the returns were being processed, even though there were a lot of judicial precedents in the favor of the taxpayer, such amounts were disallowed while processing the return itself. Whereas in section 143(1), it says that only mistakes apparent from record kind of things which can are the things which can be adjusted from the returned income. Now, when there were judicial precedents which were available at the time of filing of return and at the time of processing of return also, and when the processing of return was happening, this particular amendment was not in place, whether the assessing officer or the CPC unit was under authority to make those adjustments or not. Now I have received one CIT appeal order yesterday night only, wherein the CIT appeal has disallowed the appeal of the SSC by saying that this clarificatory amendment is retrospective in nature, and because the adjustments were very much apparent from the tax audit report, the assessing authority was very much within its power to make those adjustments. Now this controversy is going to get snowballed, I think, to a little extent for a few years, and it is going to now get decided whether prior to this amendment adjustments could have been made under section 143(1) or not. We need to see how it evolves, this controversy evolves. Although the clarificatory amendment has been made, but for a few years prior to the amendment, this controversy is still going to remain in existence. Moving on to bad debts. Bad debts is written off as recoverable. We all know bad debts need to be written off, but there was insertion of second proviso in through Finance Act 2015. It says that even if you consider it as a recoverable, and even though it is not written off as such in the books of accounts, you can still claim it as bad debt, but you need to prove it that how you consider it to be irrecoverable. Also, provision for bad and doubtful debts are not allowed. That is specifically mentioned. So let's move on quickly because we have to cover many more things. Insurance premium, it is one of the amounts mentioned as allowable deduction. Health insurance premium in terms of employees, a special reserve, 20% of profits of eligible business transferred by banks and NBFCs to special reserve shall be allowed. These are in respect of specific businesses only. Then family planning, revenue expenditure for promoting family planning amongst its employees is allowed as deduction. In case of capital expenditure, expenditure incurred is allowed as deduction in 5 equal installments also. So in terms of family planning, so banking cash transaction tax. So if you now recall that if there is cash withdrawal of more than 1 crore rupees from bank, then there is particular banking transaction tax, cash transaction tax, which is applicable, that can be claimed. Banking cash transaction tax paid by SSC during previous year on taxable banking transaction shall be allowed as deduction. There used to be, I think, some few more other transaction tax transactions which were covered under banking transaction tax earlier. It is also in respect of those, but I think those are not too relevant now. The 1 crore rupee cash withdrawal which I'm talking about, probably that is a TDS which needs to be deducted. So that TDS would be claimable as deduction, claimed as credit only. It might not be considered as banking cash transaction tax. It was something else which was introduced earlier. Securities transaction tax, which in the stock exchanges which we pay, is allowed as deduction. Commodity transaction tax, cooperative society, expenditure incurred by cooperative societies engaged in manufacture of sugar for purchase of sugarcane at price equal to or less than price fixed or approved by the government. So wherever there are cooperative societies engaged in manufacture of sugar, means there are a lot of cooperative societies of farmers which have set up their own manufacturing facilities. So in terms of purchase of sugarcane from the farmers, only the amount will be which will be allowed as deduction is price equal to or less than the price fixed or approved by the government, right? So it is a regulated market, which we all know. Mark to market losses as per the ICDS, whatever mark to market losses are prescribed in ICDS, they can also be claimed as deduction, revenue expenses. And this was inserted with Finance Act 2018 with retrospective effect from April 2017. This is one of the amendments which was brought in as a result of that case law which was pronounced by Delhi High Court in, I think, November 2017. Right, let's move on to general deduction in section 37. This is very generic, which we all know. These are basic concepts of claiming a deduction under section 37. Basically, it has to be incurred during the previous year, incurred wholly and exclusively for the purposes of business, not incurred for advertisement or souvenir in political party. So basically, you cannot give advertisement in political parties brochure and claim it as expense. It should not be incurred for personal purposes, we all know. Now, many times what happens is that if a company's director has incurred certain expenses in personal capacity, they might be included as perquisite in the salary. Now, if that income has already been taxed as salary income in the hands of director, then it cannot be classified as personal expense in the hands of the company, right? Because company is an artificial juridical person, so company cannot incur any personal expense. So it has to be a certain expense which was for the purposes of business of the company. In those circumstances, many times we have seen in assessment proceedings for companies also, they ask that what are the, please provide the list of personal expenses which you have incurred, or they try to say that certain expenses incurred towards directors or certain key personnel are personal expenses in nature. So that should not be a claim, and you should argue it, right? That if they are employees, we have incurred expenses for employees. These are for the purposes of business only. Now, allowances can be claimed based on principle of commercial expediency. It has to be commercial in nature, not incurred for purposes of business being offense. As we have mentioned, we have discussed that there should not be illegal expenses. Obviously, interest paid for violation of provisions of any law shall not be construed as offensive. For example, if you have paid GST late and you're incurring certain expense of interest, say for example, if you have made any late payment of professional tax and you have paid an interest on that, these are not violation of law. These interests are compensatory in nature and thus allowed as deduction. However, any interest paid on income tax is specifically disallowed under section 40. It cannot be capital in nature. It has to be revenue in nature. CSR expense, the 2% CR expense, which has to be incurred by the companies, that is not allowed as deduction. And if you are incurring, say for example, if you are not a company and you are out of your own free will in order to promote certain area around your businesses, to promote the welfare of people living in the vicinity of your business, and to promote your brand name, you are sponsoring such certain events, or building certain roads, or putting up some traffic lights. All those expenses can still be claimed as business expenditure, because there are judicial precedents which say that these are to enhance your business standing in the society. Therefore, such expense can still be claimed as expense if you have not classified that as specifically as CSR expense for your corporate loss purposes. Right? Now, incurred in respect of business, it has to be in respect of business and not covered under section 30 to 36, because those are claimed under those sections only. So it has to be a residual kind of an expense which has to be claimed as deduction under section 36. So this is a residual kind of a section. We move on to building, etc., partly used for businesses. Let's move on from this. Let's move on to section 40. It's basically talks about certain disallowances. 40 imposes restriction on allowability of certain expenses and is in the nature of exception to section 30 to 38, that it overrides all these sections. It says clause A of 40 talks about all SSCs. Basically, it is applicable to all SSCs. Then clause B applies to partnership firms, and clause BA applies to association of persons and body of individuals. Then we talk about it was introduced to basically to avoid, to restrict people, taxpayers, from avoiding taxes, right? In those in various circumstances, there can be these particular provided in section 40. What are all those disallowances which have been provided? Section 40, which are common to all assessees or taxpayers, is 40A-IA. It talks about payments to non-residents. Basically, what are those payments? Interest, royalty, FTS, or any other sum chargeable under the Act. If it is any other sum chargeable under the Act, and if you have not deducted TDS on that particular amount of expense, then that has to be disallowed. And how much is the disallowance? It has to be disallowed in totality, 100% amount has to be disallowed. When it will be allowed? It will be allowed in any subsequent year if you deduct tax and make the payment thereof. If the amount is deducted in the previous year but paid after the due date of filing of return of income, then in the subsequent year it will be allowed whenever it is paid. So this is basically similar to provision of residents also. We'll talk about the residents. But in terms of what is the interpretation of any other sum chargeable under this Act, there are certain doubts which have been raised as whether term refers to whole sum being remitted or only proportion representing the sum chargeable to tax, sum chargeable to Act. Say for example, if you have made a payment wherein particular, say for example, if you have made a payment of 100 rupees to a particular non-resident, out of that 100 rupees, only 40 was to be charged to tax. But now when the disallowance is to be made, whether the disallowance will happen for the 100 rupees or for the 40 rupees, which was some chargeable to tax. In my personal view, the disallowance should happen for the entire 100 rupees, because as a taxpayer, one is not authorized to determine whatever is the portion of sum chargeable to tax in a particular amount. If there is certain sum which is chargeable to tax in a particular amount, then the entire sum has to be subjected to tax under TDS under section 195. So that is my personal view. There are other views also available which say that no, if it has to be only 40 rupees which was chargeable to tax, then only 40 needs to be disallowed. So this is something which is open to interpretation, and one is free to take the interpretation. Then what CBDT has clarified, for purpose of making disallowance as other chargeable, the appropriate portion of sum which is chargeable to tax under the Act shall form the basis of such disallowances and shall be the same as determined by the AO having jurisdiction for the purposes of section 195. So the CBDT has also clarified that if you have to determine this particular amount, it has to be determined by the AO only. Even after certain, means these clarification, certain people take a position that no, even a chartered accountant or even the taxpayer is competent to, if the facts and circumstances are clearly evident before them, they can still determine on their own. The AO shall determine the appropriate portion of sum chargeable under section 195(1) to ascertain the tax liability on which tax is required to be deducted. Right. So this is something which has been clarified by the government, by the CBDT, and therefore, if you are yourself determining the sum chargeable to tax without having recourse to the assessing officer, please be mindful that a challenge may come from the tax officer. Now, similar disallowance is also provided in the terms of resident assessee, where you have made the payment of sum to a resident assessee, but have failed to deduct tax in a particular year. Then, in case of resident, the sum which is to be disallowed is only 30% of the total sum paid. So, for example, if you have made a payment of 1 lakh rupee on which tax was deductible under 194J, but you have not deducted that. So, 30% of 1 lakh means 30,000 will be the amount of disallowance, not entire 1 lakh rupee, right? And if in the subsequent year you deduct tax and pay it to the tax authorities, then that 30,000 will also be allowed in the subsequent year. Then there is one exception which has been provided in the Act, which says that if the recipient of income has already disclosed that amount in its own tax return and have paid taxes on that particular income, and a chartered accountant issues a certificate in Form 26A. Form 26A is the prescribed certificate, means chartered accountant has reviewed the income tax and the books of accounts of the recipient of income, and he certifies that yes, the income has been included and the proper taxes have been paid. Then the payer of that sum can claim that no disallowance shall be made in my hands because the recipient of income has already paid the taxes, right? And the recipient must also have filed its tax return. So these are, if all these conditions are satisfied, you can claim. And generally it happens many a time, because I can tell you that in earlier years there was a NBFC company which was a big company of an auto manufacturer group, and there they used to receive EMIs, and in EMIs many corporates used to, because that was a luxurious brand, and they used to pay huge EMIs, which also used to include interest component. And on that interest component, many times the corporate assessees used to fail to deduct tax. There we used to issue certificate under section under this Form 26A, certifying that yes, all this interest income has been accounted for by the NBFC company, and they have also paid due taxes and they have filed their tax return, and therefore no disallowance should be made in the hands of the owner of the car, basically, who was paying the EMI. So this is section which is very useful, which should be used wherever you can make use of it. Now, in equalization levy, if you have to deduct equalization levy on advertisement expenses payable to a non-resident, even that is amount which is disallowed if you have not deducted tax. 100% is disallowable, and if you have subsequently made the deduction and paid that amount, you can claim it in the subsequent year. Then there are certain other disallowances which are taxes not deductible on income. Basically, the income tax, interest on income tax, and foreign tax credit. These cannot be claimed as deduction, but which can be claimed as deduction is excise duty, customs duty, GST. All these taxes are indirect taxes. They can be claimed as deduction. Then any wealth tax paid cannot be claimed as deduction. this is very rarely used by a state government undertaking. This disallowance is applicable on a state government undertaking of any royalty, license fee, service fee, privilege fee, service charge, or any other fee which is levied exclusively on state government undertaking by the state government. So what the central government was feeling, that to reduce the taxes of state government undertaking, state governments were levying some exclusive royalties, license fees, and etc. on state government undertakings. So in order to reduce that practice, this particular disallowance was brought in. Then salary paid outside India to a non-resident, if tax has not been deducted on such salary. Please mind that there is no provision in this particular disallowance that if you have deducted tax subsequently and paid it to the tax authorities, it will be allowed in the subsequent year. So what happens is that if you are making a payment of salary to an expatriate, non-resident expatriate employee, non-resident means they are based out of India, they are not resident in India, and you have failed to deduct tax. Say for example, tax was deductible in India. In certain circumstances, it may happen that the non-resident was working from India, say for example, for 70 days or 80 days. But the non-resident was working for predominantly outside of India. For that, those 60 to 70, 80 days, because he was working from India, that salary can be brought to tax in India. So on that portion, if tax has not been deducted, then it can become a dead loss. In payment to provident fund or other provident fund, other established funds, benefit of employees, unless arrangement has been made to secure the tax has been deducted, means basically to secure the interests of revenue, wherever tax has to be deducted, it has been prescribed. Any tax paid by employer as referred to a non-monetary perquisite. So there are calculation on non-monetary perquisite that multiple grossing up is not to be done, and if this 10cc benefit is claimed in terms of non-monetary perquisite which are paid to the employees, and tax is paid according to this particular subsection, then this tax which is borne by the employer will not be allowed as deduction. Left with 3-4 minutes, so let's also talk about certain more deductions. Payments to relatives or associates or associated enterprises, 48(2). Basically, it's not a specific disallowance, but there are conditions that this has to be on arm's length price, notwithstanding anything contrary to any contained in any other provision of this sect. So basically, it's start with non-obstante clauses. Cash disbursements from items of expenditure. So basically, there are certain thresholds which have been prescribed under section 40A3, 40A3A. If those cash expenses are incurred in breach of those limits, that has to be disallowed. Disallowance for provision of gratuity. Now this is 40A7. If you have provided for only for provision, it has to be disallowed. But if you have actually made the payment, it has to be claimed on actual payment basis only. Payments by employer to fund, trust, company, AOP, BOI, registered societies or other institution under 40A9. Disallowance of mark-to-market losses. Basically, these are specific mark-to-market losses which are disallowed. And here, which are specifically disallowed, will also not be allowed under ICDS. Right? Now 40A2, basically payments to relatives, associates and associated enterprise. As we would have seen, expenditure for which payment has been made, which is excessive or unreasonable, has to be disallowed. And how you can find out? Basically, you can find out what is the fair market of value or goods or services or facilities which they are providing. Generally, we tend to ask the companies that if you have taken a fee quote or a quote from a third party in terms of similar kind of goods or services to be provided, whether there was a legitimate need of business or profession to avail those services, or we have just availed the services to pass on the income to our associates or related parties. So all these judgments we need to take care. Benefit which are derived, what is the benefit which is being derived by the business by availing such services from associates or related parties. So all these things need to be seen. and then it need to be derived that whether this is excessive or unreasonable. The assessing officer may disallow so much of expenditure as he may consider to be excessive or unreasonable. Now, this is something which we all know how AOs decides on the reasonability. From AY 13-14 to AY 16-17, SSCs were required to obtain certificate in, this was domestic transfer pricing basically, under section 92D. For domestic transactions also which were exceeding a prescribed threshold, CA was required to certify that yes, these transactions are at arm's length price. However, with effect from 1st of April 2017, expenditure in respect of payment which has been made to person in 40A2B are excluded from the scope of specified domestic transaction, STT, right? Now, what is relative for an individual? Any relative of such individual, it has been defined. It includes spouse, brother, sister, and any lineal ascendant or descendant. Section 241. So please be mindful that relative has been defined differently for different provisions of the Act. So in section 56, you may find different definition of relative. So you have to see what definition is applicable for this particular purpose, for this particular section. It is defined under section 241. So you have to take the definition of relative only for this section only, and not from any other provision of the Act. For company, any director, any relative of such director or partner, any person in whose business or profession the SSC or director have a substantial interest. Substantial interest means for a company, person having not less than 20% voting power. For others, person not less than 20% of profit share. So 20% basically, if a person is controlling 20% and a relative, you are dealing with the relative of such person, then that would qualify as related party transaction for the purposes of Income Tax Act. Now it is cash disbursements, expenditure for which payment has been made in excess of 10,000 in a day to a person other than by way of account pay check or account pay bank draft or by use of electronic clearing system through a bank account shall not be allowed as deduction. So 10,000 is the limit per day. Also, it talks about expenditure for deduction has already been claimed in any preceding year and the payment for which has been subsequently made other than by the account pay check in excess of 10,000 rupees, then such payment shall be deemed to be considered as income of such subsequent year. Say for example, if you have already claimed an expense in assessment year 2010-11, but you have not paid that amount. Now, in current financial year, you were to pay that amount in cash. Even then, if the amount paid in cash is more than 10,000 rupees, then in current year, it will be treated as your income, right? So expense you have already claimed. So now it will be treated as your income. In case of payment made for plying, hiring or leasing of carriage, the limit shall be 35,000 for a person in a day. You can also refer to Rule 6DD for this particular disallowance. For gratuity, it says subclause 2A states that no deduction shall be allowed in respect of any provision made for payment of gratuity to employees on their retirement on termination of their employment for any reasons except as laid down in subclause B. What is subclause B? Approved gratuity fund. If it is approved gratuity fund, no disallowance shall be made if SSC makes a provision for contribution to an approved gratuity fund. So if you have approved means approved from the income tax authority. So you can approach income tax authorities and get the gratuity fund approved. And if it is approved, even the provision you have made in the books of accounts, that can be claimed as deduction. And second, payable during the year, no disallowance shall be made if the provision was created for gratuity which has become payable during the year. Means if it is approved basically, then you can claim it on provision basis also. Otherwise, you have to claim it on payment basis only. Let's skip this, move on to 43B. Quickly see the 43B. We all know 43B talks about payment expenses which are incurred, which are to be allowed only on actual payment basis. So even though previous sections would have provided for deduction of certain expenses, these expenses might be covered under earlier sections only then it will be claimed as deduction. But Section 43B comes with a rider, and it says that these list of expenses, which is tax, duty, say for example, if GST or any other kind of tax which are payable under any law. Law means whatever has been created by statute, either by the central government or by the state government. If any tax, duty or cess or fees to be paid, municipal taxes, your local taxes, your GST, excise duty, all these expenses will be allowed only if you have made actual payment. PF, superannuation, gratuity, or any other fund. Now, gratuity, what does it mean? Gratuity, it says that any other fund. Now, gratuity was also there in 40A7. Now, what happens is that 40A7, although allows the provision of gratuity for towards approved gratuity fund to be claimed on accrual basis, but 43B comes with a rider. It says that even if it is gratuity, whatever gratuity it is to be allowed only on payment basis. So therefore, 43B somewhat overrides 40A7 also. Bonus commission, interest on loan from public financial institutions, state financial institution, state industrial investment corporation, basically to secure the interests of banks. Interest is allowed on payment basis only. Scheduled cooperative bank. Some payable leave encashment. Leave encashment is also allowed only on payment basis. Some payable to Indian Railways for use of railway assets. So if you have moved cargo from day and you have to make a payment to railways, that amount also is to be allowed only on actual payment basis, right? And all these expenses can be paid till the due date of filing of return. Means if you have filed the return before the due date itself, till the date of return, filing of return. So if you have made these actual payment, only then you can claim it. Otherwise, you have to claim it in the subsequent year. Now, ICDS 10 also talks about certain provisions in contingent liabilities and contingent assets. It says that when a provision can be recognized other than 43B, say for example, if you have to claim an expense on an accrual basis, then how you can recognize a provision? It says ICDS 10 provides a person has a present obligation as a result of a past event. It is a reasonably certain that an outflow of resources embodying economic benefits will be required to settle the obligation, and a reasonable estimate can be made, right? So all these three conditions can be has to be satisfied on the date of when you are creating a provision or claiming that provision. Now, what are exception to it? Say for example, there is an asset restoration expense which you are probably liable to incur, say for example, at the end of 10-year lease period. You have to create the asset, you have to bring the asset in its original shape, and you estimate that yes, I'll probably incur, say for example, 10 lakh rupees at that point of time. Now, probably that expense might not be claimable as expense in the year now, because there is no present obligation as a result of a past event. It is a future event which is going to happen. Although there might be reasonable certainty and there is a reasonable estimate which is there, but it is not a present obligation which is a result of a past event. So therefore, certain expenses which are to be incurred in future might get under a cloud of ICDS 10 now, right? Even though asset restoration expense is to be recognized as an expense, as a provision as per Ind AS, it might be recognized as per IGAP also in certain circumstances. Say for example, debenture redemption premium, if you have to pay at the end of the year, at the end of the debenture term, that you might have to accrue over a period of the terms of debenture, then all those provisions might get clouded under the definition of provision under which is given under ICDS 10, right? Now, what is a certain contingent asset must be assessed continually whenever it becomes reasonably certain that inflow of economic benefit will arise. The asset and income are to be recognized in the previous year. So earlier we were talking about the expense. Now contingent asset means income. So whenever there is a contingent asset, but you have assessed that there is a reasonable certainty that economic inflow will happen, then you have to recognize it as income. Provisions and contingent assets will be reviewed at each year end and reversed if they do not meet the recognition criteria. Section 41, basically it is cessation of trading liability, which has been claimed as deduction in earlier years. If now you have ceased to pay that, means you are not required to pay that amount of liability, then it will be classified as the income in which the cessation happens. So remission or cessation thereof has to happen. Deduction was allowed. So this is one of the basic criteria. So for example, you had taken a loan from a financial institution, and due to certain restructuring of loan, the amount is reduced. Now, because you have not claimed that loan as deduction in any previous year as tax deduction, that restructuring of loan which has resulted in reduction of your liability will not result in section 41 income, right? So the basic criteria for 41 income is there must have been a deduction which has been claimed in earlier years. There has to be cessation of liability. There has to be a recovery of any loss. There has to be recovery of any expenditure. Liability must be a trading liability and not on capital account. Person is allowed deduction. Person has already claimed deduction or allowance in the same previous year or any previous year, any other previous year. So in those circumstances, your profit will be chargeable to tax. Balancing charge, if an undertaking is engaged in the business of generation or distribution of power, which we have talked about, that where the depreciation is chargeable on straight line business, has opted for depreciation on straight line business and subsequently transfer such assets for consideration more than the WDV, then this surplus to the extent of depreciation has already been allowed. Then the excess shall be chargeable to tax under this balancing charge. Foreign currency fluctuations, construction contracts. This is important. So as I mentioned that in revenue recognition, construction project is also there. There is ICDS 3, which specifically talks about construction contracts. And now this 43 CB has also been inserted in the Act itself to cater to all those challenges wherein it was mentioned that you cannot bring in changes to the recognition of income as per the notification only. So this section is only the replica of ICDS 3. Basically, it says that income from construction contracts or service contracts has to be computed on percentage completion basis. And as per ICDS notified under section 145(2). What does it say is that in terms of continuous service, if the service contract is for a limited period which is less than 90 days, you can take completion basis method only, but only for those contracts where the services are to be rendered in a period of less than 90 days. So completion method is only allowed to be taken for those projects. Wherever there are projects which are exceeding 90 days, it has to be on percentage completion method. And there are also contracts which are kind of AMC contracts, which are for indeterminate number of activities or service performances over a period of time. So for example, if you have entered into an AMC project wherein AMC contract wherein you can be called upon to repair the asset multiple number of times and n number of times, there is no restriction, and the AMC contract is for 2 years, so the contract revenue has to be deferred for a period of 2 years, over a period of 2 years. You can do it. That has been mentioned in the ICDS as well as on 43 CB also, right? So retention money has to be included in the contract revenue. Say for example, if there is a provision of 5% of retention money, if your contract revenue is 100 and there is a provision that 5% will be retained by the your customer till that certain period of time of performance. However, when you are apportioning the revenue towards your project revenues and you are calculating the projected revenue in terms of your percentage of costs incurred, then entire 100% has to be considered. You cannot say that 5% to bhi milega hi nahi. We'll not consider, we'll only consider 95 as the project revenue. No, you have to consider 100%. And say for example, if 30% costs have been incurred, then out of 100 of revenue, 30 rupees of revenue must be recognized in the computation of income also, right? So contract costs need not to be reduced by incidental income. So if you're if there is certain interest on earnest money deposit, sorry, excuse me. So what used to happen is, say for example, during the gestation period of the project, you have have not been keeping well of late. So contract costs, what used to happen is generally during the period of contract, there might be a condition that you have to put in earnest money and you are earning certain interest from that FD. People used to deduct the contract cost, right? So what happens is that you have incurred 30% of projected costs on a particular project, and you have, say for example, earned an income of 4 rupees. So you will reduce you might reduce 4 and say that only 26% of the project cost have been incurred, and therefore you will only recognize 26% of the projected revenue. So the ICDS and 43CB say that you cannot deduct incidental incomes from your projected cost so as to reduce the proportion of revenue to be recognized, right? So this is what it means. Presumptive taxation, I'll just take 5 more minutes to talk about presumptive taxation of 44 AD, which is talks about eligible businesses. Eligible business means carried on by individual partnership firm other than LLP. It is not allowed for LLP or a company. It is only allowed to individual HUFs or partnership firms, which has not claimed any deduction under these sections. So this becomes eligible assets. Now, what should be the business? Business should be services earning it should be any business other than. What are the exceptions? Commission or brokerage business, agency business, plying, hiring or leasing of goods carriage, because there is a certain other section for plying, hiring or leasing of goods carriage. And your business turnover should not exceed 2 crore rupees. If you satisfy all these conditions, you are eligible business, and you can offer your income on presumptive basis, and basically it is something which is mandatory. If you have opted for this particular section once, you have to offer at least 6% if your earnings are in other than mode of cash, and if you are also earning in cash, you have to basically offer minimum of 8% of income as tax. Say for example, if your revenue is 100, you have to offer at least 8 rupees as income chargeable to tax. If you have opted for it once, and if you reduce it, you have to get your accounts audited as per 44 AB. What does it say? Deductions shall be deemed to have been allowed. All these deductions shall be deemed to have been allowed. All depreciation shall be deemed to have been allowed. Then earlier, in terms of partnership firms, what used to happen is that 6% or 8% was the presumptive income which was offered to tax, and out of that 8%, you could also claim partner's salary as deduction. So chargeable income was further reduced. Now with effect from 1st of April 2017, salary and interest paid to partners shall also not be allowed, and it would have been deemed to have been allowed. This has to be followed on a consistent basis. Once it is opted, it has to be at least followed for next 5 years. You shall not be allowed to claim benefit. Sorry, if you have opted out of it, you will not be allowed to claim back the benefit for next 5 years. And you are not opting for presumptive income, you have to maintain and get your books of accounts audited. Similarly, there is a section called 44 ADA for professionals, which is basically legal, medical, engineering, architectural, accounting, technical consultancy, interior designers, and whose gross receipts do not exceed 50 lakh rupees. So please be careful that for professionals, the limit is only 50 lakh rupees. Now, you would see we have come across many people who are management consultants. Say, for example, they were at senior positions earlier. Now they have moved into their own consultancy firms. What they are guiding businesses is about how to do business, where to get contracts from, how to do your sales pitch. Yeah, they are guiding their senior managements to perform better. So if you would see that management consultancy is not a profession, it is not one of the listed professions. So therefore, a management consultancy can be claimed to be a business and can be offered to tax under 44 AD rather than ADA. So this is something you can work around and you can see and whether any benefit can be made available to the taxpayers. Now also, if you would see for profession, the rate of profit is much higher. It talks about 50% because generally it is assumed that a professional is giving more of personal time and there are much less expenses incurred in carrying on of a business. So therefore the deemed percentage profit is 50%. And now this is also not available to LLPs. Earlier the LLPs were not excluded, but now there has been an amendment made in 44 ADA and LLPs are also excluded. Similar to AD, all deductions would have been deemed to be allowed. And if you don't opt for it, means if you have opted once and move out of it, then you have to get your books of accounts audited. So that is it from my side. I'll share this presentation with you. You can read it in your leisure. And if you have any queries, you can come back to me. This is my mobile number. You can note it down, 9899 784 884. And on email also, you can reach me anytime. And I'll be happy to answer. So in interest of time, I think we should conclude this session. And we have a WhatsApp group. If you have any further queries, you may please feel free to ask there. Neeraj ji, over to you.
Yeah. Sir, thank you. Thanks a lot, Anshul sir. Even I was also listening and it was really a wonderful deliberation, sir. And as very rightly quoted by Neeraj in the starting of the session in your introduction, I endorse his view, I second his views that you are the backbone of the entire program. And not only for this particular course, I believe that all the courses which we people are offering, most of the courses are designed by you and you are putting a lot of your efforts to make these programs successful. So thank you so much, sir, for your time. And I request all the participants, in case you have any doubts, Anshul sir is always available at every point of time to serve the profession and all the learners as well. So you are connected with our WhatsApp group. You may ask your question there and Anshul sir will be very much happy to answer your questions. And kindly join us tomorrow, though we are going to share the recordings of the sessions. But I believe the live sessions are better because in the live sessions, we can ask the questions. So due to the time reason, there may be some questions maybe unanswered today. So I request Anshul sir and I also request participants too. So kindly ask these questions in the WhatsApp group and sir will answer there. Tomorrow we are going to have discussion on two important topics. The first session will be taken by Dr. Ravi Gupta ji, who is Associate Professor in Sri Ram College of Commerce and also he is Government Nominee Central Council member of ICI. And he will discuss about important aspects in capital gain. And in the second session, Anshul sir is going to discuss with us about practical challenges, issues, and all the one-to-one queries in relation to Form 15CA, 15CB. So thank you so much for joining us. Those who have not received the link of WhatsApp group, they will receive the email today. And in that email, they will have the link for the recording for both the days and presentations and the link for WhatsApp group as well. Thank you so much. Thank you, everyone. And once again, heartiest thanks to Anshul sir for all his cooperation and support, despite of he's sharing his knowledge with us. So thank you so much, sir.
Thank you, Dheeraj bhai. Thanks a lot. It's always wonderful to have take session in the courses organized by you, and your relentless effort to serve the profession is, hats off to all those efforts. Thank you very much, Dheeraj bhai. Looking forward to tomorrow's
Thank
session
you.
as well.
Okay.